Hi, welcome to Elevate Market Chat. In this video, which was recorded on March 17th, 2022, Shane and I are just going to discuss some of the things that we see in the market, what we like, what we don't like, and just have fun. So this is not investment advice. This is just two guys that love the markets, well credentialed. So we kind of know what we're talking about, but generally we're just enjoying this and we're along for the ride. So again, not investment advice, and hope you enjoy this.
You're green, by the way. Oh, you got a hat on.
I got the Elevate hat.
A little bit of green in your hat. There you go. That's awesome. Yeah, so I guess Fed was out yesterday with their first rate hike in a very long time. I don't have the exact data with me on how many years and how many meetings it's been since the last time they actually raised interest rates, but certainly been a couple of years since pre-COVID.
Yeah, I think we're looking at 3 years on that. So yeah, it's been a good bit.
Yeah, it's been a while. And I mean, the intraday action yesterday was pretty typical. I mean, the Fed generally what happens is the first move is the wrong move. What do you got there? The hourly? You're trying to go intraday on us here?
Just to chart? Highlight kind of what you're talking about. On the hourly, here's what we're looking at with the Fed. So it rallied overnight. Everybody got a little excited, I think.
But even the day before, so sorry to interrupt you, but the day before and then yesterday morning, everybody was buying stocks because there's a lot of cash sitting out there right now, and a lot of people are underinvested. And so what happened, I think, over the prior 2 days, yesterday morning and the day prior was everybody was positioning, trying to buy front run the Fed announcement, which everybody expected a 25 basis point rate hike. As I wrote about in a couple of my market commentaries, they had initially some of the Fed governors had been talking about potentially raising by 50 basis points, and Powell said a couple of weeks ago when he was testifying before Congress that he was going to propose and support a 25 basis point hike. So I mean, going to 25 basis point hike from an anticipated or potential 50 basis point hike is bullish, right? It's less restrictive, or not as bad as it could have been, kind of thing. And so market's all about expectation. What happens versus expectation. And so if the market was expecting, or at least there was a potential for a 50 basis point rate hike, and they only did 25 basis points, well, that's a reason to buy. Whether that's real or not, I don't know, but that's kind of how the market behaves, is just based on expectations. So
yeah, and I think it's interesting, on the hourly there. So we did see, it sold off and then it bounced up. So you had a nice little rally there. The Fed talks about raising the rate over the next 6 meetings, so 6 more hikes, but they've planned a lot before, and I think that's where it's always kind of going back to the chart. So they have plans, they don't always come to fruition. I know we were supposed to be selling mortgage backs off the balance sheet a long time ago, and here we go again. We're going to plan them for the next meeting is kind of what they communicated. But you cut through that noise and you look at the chart, and I think that's what we do. We might have varying time frames, you and I, but certainly we saw a little bit of bullishness. But big picture, did this change anything for you?
No. No, I mean, I guess just to remind anybody who's actually watching this, I trade my personal accounts way differently than I manage money for Elevate clients. We're much more long-term investors in the Elevate portfolios, and in my short-term accounts, I'm far more actively trading. And so so I mean, I made a couple of trades yesterday because there's an event in the market that is certain to create volatility, either upside or downside. And so yesterday I actually shorted the S&P 500 and the NASDAQ on the print from the Fed. And of course, the market dropped initially from those levels pretty hard. I mean, let's see if I can control this. What happened was the market dropped from, maybe this area all the way down to the bottom of this candle right here. Now, some markets were down maybe a couple percent, actually turned red for the day. So we're down for the day at one point. And then, as I was saying before, the initial move on the Fed print is often the wrong move. So I had it right for a minute, and then I never closed those positions until the market went back up to its high point for the, got it back above that point about an hour later as Mr. Powell was talking and telling everybody that the economy was in such fine shape, and that's why they were able to raise rates. And to me, I just think it's all nonsense. He did a great job of talking the market higher on the call during the press conference, I should say. But the truth is that the Fed is way behind inflation right now, and they're going to stay behind inflation. They're going to need to raise rates. They're going to need to trim the balance sheet. I've been saying for, I don't know, half a year at least that they should have stopped the accommodative policy, stopped quantitative easing, stopped buying bonds immediately. Like none of this taper nonsense. Like think about how the Fed was buying bonds to stimulate economic growth and keep rates artificially low, literally until last week. And this is with inflation at 7.5% year over year, and they're buying bonds and they're easing. It makes absolutely no sense. And then suddenly today, or yesterday, there's finally an interest rate to talk about. It's no longer zero. But don't get me wrong, 25 basis points to 50 basis points, like it's still super accommodative from a monetary policy perspective. It's not restrictive in any way, shape, or form. So I mean, there's still very little cost to borrow money, especially in the overnight markets, which is the rate that we're talking about, obviously. The rate that banks charge each other to meet reserve requirements at the end of the day. So,
right.
I mean, so inflation's not going to react to this. I mean, and even again during the press conference, they acknowledged that the war in Ukraine is just going to further disrupt supply chains and probably, keep prices at an elevated level for certainly in the short term. I mean, none of that's going to resolve overnight. It doesn't seem like. Oil today, by the way, is up 8.5%. Natural gas is up 4.3%. Oh, I guess oil dropped a little bit. It's only up 8% now. So,
it's interesting too, looking at oil, we had that run up to 130, sold off. And then, if you want to pull a chart up of oil here, but
well, I was just pulling up the SPX to try and get rid of all those silly red arrows.
But oil, it sold off 130. It came down, tapped 95, which was kind of that initial breakout range. And now it looks, we'll see how the day closes, but it's just about to reclaim the 20-day moving average. And the 20-day moving average is always a good indicator for short-term momentum. Any stock or anything trading below the 20-day always starts there before then it finds the 200-day, goes lower if that's the direction. But looking at this, we've reclaimed that 20. If we close above it, it's kind of setting up like it could go higher from here. But risk reward here, it's kind of a spot where you retest that breakout. And I'm no oil expert, but the trend is up, and nice little bounce back into that short-term moving average.
Yeah, I don't trade oil. I have made it my business to basically never trade something in which a cartel is so heavily involved and can manipulate prices so simply. So I personally don't ever trade crude oil. But yeah, I mean, the trend is up. There's kind of no doubt about that. You can draw the line a few different ways, but if you draw it here, I mean, that's pretty much where the trend is. No surprise, a bounce there just above the 50-day moving average, running into resistance at the 20-day, but kind of hanging above that. I'd say if it closes above the 20-day, chances are probably continues higher for at least a little while. I mean, I wouldn't short it here. I really don't think, I don't know how much edge there is at that point. I personally, like I said, don't trade oil, so I won't be going long here either. But we are looking at buying XLE in our Elevate portfolios today. I think that was the wrong ticker. I just clicked. So in our Elevate strategies, both growth and value have a position in XLE, and not exactly the same as crude, but pulled back from highs. Pulled back what? I guess from the absolute high, we pulled back about 11%. So gives us an opportunity to put some money to work for some of our newer clients that aren't already in the XLE trade. And so we'll be nibbling a little bit there for some of those people. For people who have been with us a long time, they're already in. And again, just like we drew last week, I mean, ultimately the trend going all the way back to when oil cost negative dollars, the trend is still up. And until we break down below, I think even further, like this purple line and the 200-day moving average, I don't see any reason to aggressively sell crude. That said, or XLE, and this is the recent low. So, I mean, there's all types of support below here, and there's no telling how high XLE can go. Again, XLE is the energy ETF, so it's not 100% oil producing stocks. There's another ETF called XOP where you can get that. But the main idea here is like oil. I mean, oil is, gosh, what is it right now per barrel? A little over $102
Yeah,
a barrel.
it is. And then, it's just interesting too. We're not oil experts. The most hands-on experience I've had is changing the oil in my car or gassing up at the pump. You just look at the trend; it's holding all the averages, and you can't really argue with that.
No, and on what I was getting at, I guess, on the fundamental side is like XLE doesn't need oil to keep going up in order for all of the stocks um, inside of this fund to do very well. They don't need oil at $100 a barrel. They certainly don't need oil at $130 or $145 a barrel. The top two holdings in XLE are Chevron and Exxon at 22% each. Then EOG Resources, ConocoPhillips, Schlumberger, Pioneer Natural Resources, Occidental Petroleum, Marathon Petroleum. Like these guys all make a lot of money at $60 a barrel, $70 a barrel. So as long as oil doesn't crash by more than half, all those companies are going to be, making a very nice living, reporting strong earnings, reporting strong revenue, and oil can go down, 40%, 30%, and those companies still don't really have any issue. I mean, what was an issue is when oil was negative money. You don't want to be an oil producer when oil costs negative money. So yeah, I think there's plenty of upside left in the energy space. Crude oil is something I don't personally bother with ever, but it is a major factor in how XLE will perform. They're very highly correlated, I guess is another way to say it.
And then it's interesting. So, looking at this chart, you look at this and you look at the S&P 500 and they're looking different. XLE is a clear uptrend with everything going on, still looks great. Are there any other sectors or, kind of stocks right now that are still fighting that trend and moving higher that you've been kind of keeping an eye on?
No, not really. I mean, not really sectors, but this is the XLE versus SPY. XLE is up 142%. SPY is only up 25% during that same period. Pretty cool. More recently.
Yeah, and you certainly have, some relative strength there. And when relative strength is strong, usually good indicator of, a good place to put some money to work. But we'll see how the trend continues, but it's looking pretty good.
So this is interesting. Since the beginning of the year, roughly, I don't know. That looks like it's roughly the beginning of the year. S&P is down about 8%. Crude oil is up, or XLE is up 28%. So that's always fun. Glad we're in the XLE. It's helping out. But no, I mean, I don't know what as far as sectors go, anything specific to be excited about right now. The market overall is in a downtrend. That means most things are in a downtrend. Gold is obviously doing pretty well because that tends to move inverse as well. So I don't have much more to say on that. Obviously, growth is outperforming value. I think we were going to touch on that a little bit.
Yeah, I think we'll turn
Or
to that.
sorry, other way around. Value is outperforming growth
And
for
I
the
was
first time in
gonna
a long time.
I was gonna turn to that. The other two sectors I was just gonna highlight, I was looking at some charts and you know, healthcare. So ticker XLV, that's just the spider ETF for healthcare, just holding a nice trend right now. And then the other one is XLU, utilities. And it's kind of funny, utilities really led the market higher earlier when everybody thought there's no way you should have defensive stocks like that moving higher. And here we are again. They're, still holding up. But at this point, those are kind of the only ones that I'm seeing where I think, hey, that's a nice uptrend. But you're right, it's kind of a
That's
broken market a little bit.
this is interesting. A little bit of a head and shoulders pattern showing up there on the
Mm-hmm.
XLV. And honestly, man, like if you, yeah, looks like I can get down there. Let's see. If you pull up the PDF of the quads that I was talking about earlier before
Yep.
we jumped on this, I mean, healthcare is one of the better. Oh, you want the PDF?
Where did,
The red
oh,
one. There you go.
here we go.
Yeah, the bottom left quadrant. I don't. We could probably zoom that in a little bit too. I don't know if I can do it. Yeah. So I mean, oh, it doesn't even show up on there. Yeah, there it is. Best equity sectors: utilities, REITs, healthcare, and communications. So when inflation, I know it's hard to believe that inflation is declining. It doesn't necessarily mean deflation. It just means disinflation, which means that, if inflation used to be growing at 7.5% and now it's only going up at 7% or something like that. Rate of change is what is important here. So inflation was going up at an accelerating rate for most of the past 6 months. Now inflation is going up, but at a decelerating rate. And so that's what the inflation down means here. At the same time, GDP is not going to grow year over year at the same rate that it grew last year. I think last year it was up, 200 some percent because we were lapping COVID when the entire global economy was shut down. And so when inflation and GDP are both slowing or falling, the best equity sectors to be in are staples, utilities, REITs, healthcare, and communications. And the worst sectors are energy, technology, industrials, financial, materials. So I mean, that's the framework that I tend to use. I don't really get too carried away with going and looking at the specific symbols. And certainly not on a daily or weekly basis, but when we need to replace or find new positions for our elevate strategies, depending on what the macro environment looks like, this is how we go and look through kind of the overall market. This is how we know where to go fishing. It's like our fish finder. Doesn't mean we're going to catch a fish every time, but it means we know where to drop the pole in the water. So yeah, and if you zoom out, we're kind of coming from quad 2. So quad 2 is up there in the top right, which is when GDP and inflation are both going up. The whole, whoa, what's going on? I don't know if it's my screen or yours, but you're all over the place. Maybe you should just stop with that.
Yeah,
thought we could just look at the whole thing. Can we look at the whole thing?
Yep. And I think my connection speed is just a little slow there. So
there you go. So yeah, I mean, there's only 4 different quads if you use inflation and GDP. They can both either be going up or down, and then there are just various intersections. And it says Hedgeye on here. I got all this research from Hedgeye. We pay those guys for a subscription. They've got a lot of analysts and a lot more research firepower than we have at Elevate Capital. So we do lead on partners for a lot of this stuff. Not to mention, last time we did one of these calls, I made it clear that like there's really no new ideas in this business. If somebody's got a new idea, you might want to be skeptical.
Yeah,
because markets haven't changed for hundreds of years. Human behavior is not going to change either.
Shane, can you just
clarify?
Trying to say something? Yeah, when you're talking about inflation and kind of the year over year rate of change going down. I just want to make sure everybody understands that. So when you're talking an absolute rate of say 5%, but now if the comparable year was say 3%, your rate of change is actually only 2% because you're comping against that higher quarter or month. Is that the best way to understand that?
Yeah, I mean, there's really like, there's two levels of the derivative there, so I wonder if I can maybe it'd be a good idea to try and share my screen. It's kind of a complicated thing to just talk about without looking at something. So maybe we should jump into that next time because I don't know how to get something like worth sharing right now
Yeah,
at the moment.
yeah, that sounds good. And then, for now, should we turn to that, value versus growth conversation?
You're the boss, dude. You're the one who's in charge. So you tell me. Meanwhile, I'll try and see if there's a way I can share something about the changes that I'm looking at because it's not just not a simple bit of math.
All right. Well, turning the conversation here. So value versus growth. JP Morgan puts out this wonderful guide that just kind of gives a guide to the markets. And, they have this chart here, and something we've been looking at is just, value versus growth. So what this chart's highlighting is that back in, 98, when value's down here, it's relatively cheap versus growth. And then when you're up here, value is relatively expensive, whereas, growth is more expensive up here, kind of goes down. Do you want to just maybe talk about this and kind of what your thoughts are?
Honestly, I haven't looked at the slide at all. I just know that it's there. So nope, I was looking for you to actually walk through that. I haven't studied this slide at all. I just know that it exists, and you can see in the market that things like Procter and Gamble and Coca-Cola and Hershey and like property and casualty insurance stocks are all doing much better over the 1 year period than something like Shopify or Amazon or any of these like growth names where revenue is growing very fast, but they don't actually even earn any money. There's a whole slew of growth names that were up 2, 3, 400% over the past couple of years, which are all down 50, 60, 70% right now and still trade at ridiculously high valuations. So those growth companies are just out of favor, and it's the first time they've been out of favor in a long time. That chart, what jumps out at me is it goes back to 1997. So it's not like that's like a 1 year chart where value versus growth kind of flip flop frequently. These trends tend to stay in place for quite a long time. Growth was growth stayed expensive for a while, um, and last time value was expensive. I don't know that chart's weird. I don't know. It's hard to read that thing.
Yeah. And, part of what it's getting at here is so down here at the bottom, most importantly, value relative to growth is cheap. And if you look at the forward PE, so that's the big one there. So right now, the forward PE on value stocks is about 15. That's right in line with the average or slightly higher than, I guess what the long-term average is. Now look at growth. Growth is trading at a 26 multiple versus 20. So what that means is that, it's price divided by equity. So you can be an instance where you get a high multiple because price is high, earnings are low. And then you can get that low by having a lower price and earnings higher. So, varying on that relationship, when you're buying up here on value, then you're paying a high price for future earnings. And right now, what this chart's telling us is down here, it's pretty cheap. And then, even nice or better to look at is over here. So, earnings correlation relative to real GDP. So that's important to differentiate is, real versus nominal. Nominal is don't factor in inflation, just what the growth is, but netting out inflation, you come down here in utilities, very low correlation to GDP, whereas industrials are a little higher. So scaling down this chart, you can kind of see, what sectors might be a little more attractive if real GDP is declining versus, rising.
Yeah, well, I'll tell you what jumps out at me on that is that the forward PEs for both growth and value are above their long-term average, and both dividend yields are below their long-term average. And that's what happens when the Fed starts manipulating stuff and pumping trillions of dollars into an economy that doesn't need it. Um, like that just it really bothers me that they do that. I mean, what are you gonna, value is supposed to be represent a value. I mean, you're supposed to be able to buy these things for less than their intrinsic value. But when you look at it, you're still paying a premium to the long-term average forward price to earnings ratio. And of course, bonds are not where you want to be with the Fed raising rates and set to raise rates and set to step away from the bond market. Like the largest buyer in the entire bond market just stepped away from the table. They're no longer buying bonds for the first time in 2 years. Um, and not only that, but they're going to talk about selling bonds, or at least not renewing their bond purchases as the bonds that they bought over the past several years start maturing. They're just going to let that mature and roll off, and that's going to have another impact on raising rates. The last time they did that quantitative tightening was 2018, and the last time the market was down for a calendar year was 2018. So I think a combination of cash and value stocks is probably the best place to be, and maybe taking some chances on growth stocks. Only because they're down, not because they're cheap, but just because they're down. And if they reclaim some of their gains, we might be able to get some upside there. But the Fed has put everybody in a really bad spot. They're basically holding our entire economy hostage, and we export that economic situation all around the globe because we're the United States of America, and it's really unfortunate. I mean, it's a very hard time to be navigating these markets, and certainly a really challenging time to be a long-term investor, because returns from here over the next 5 years. In fact, there's a slide in here somewhere. Could you just go back to the table of contents on this? There's a slide that shows like historical returns from certain Nope, go back. Oh wait, that was it right there. Oh my gosh. Nope. Next, that one. Nope. Back one. That one.
This one?
PE ratios and equity returns. So this is on the left-hand side, it shows forward PE and subsequent 1-year returns. And the little red diamond where we're at right now says that from a PE of 19.2, a forward PE of 19.2, the average return, if you draw a line to the left from where that red diamond is, it's probably like, I don't know, 4 or 5%. What does it say, 3%? No, it doesn't say, but it's certainly not 20%. I don't know why they made it such a wide range from 0 to 20, but we're right on the regression line. So I just wouldn't expect very, very good returns. Now the 1 year, you can see that all the 1-year dots are all the gray diamonds all over the place. They're widely scattered. If you look over on the right-hand side, you see the forward PE and subsequent 5-year returns instead of just the 1-year return. And it's just even lower, right? I mean, the further left you go on the chart, and I'm not sure if I can control.
And I think on this too, so the 1 year, the kind of thought there is that momentum, right? So momentum, when you have a high PE ratio, that means the markets could be trending higher and people are still putting money in the markets. So you can have that momentum carry for another year, but the dispersion's pretty wide. But when you look at the 5-year, I mean, that's pretty convincing. It's really tight grouping, and you could draw a pretty good line in there, and a lot of the dots are going to fall around that line. But that return, I mean, it is, if you look at that, gosh, it looks like 4% or so to me.
Yeah, it's not quite a quarter of the way up to the 20. So I mean, if this would be 10% here, that's not quite halfway in between. So I mean, returns are less than 5% over the next 5 years. It just doesn't bode well for being a long-term investor. You want to get aggressively long when PEs are over here in this neighborhood. Not when they're over here in this neighborhood. So, on a 1-year basis, who knows? It's like gambling, flip a coin, roll some dice, whatever you want to do. But 5 years from now, investing at a current PE of 19.2 doesn't just doesn't look like a very, smart decision to be aggressively long. So that's why I say, like in my commentaries, like the odds are not in our favor. And so we don't want to be aggressive. Sure, we have to buy some stuff. We've got to stay invested. You never know what's going to happen or when the Fed's going to come out and, decide to stimulate the economy again. So you still got to play the game. But we don't have to be aggressively buying stocks right now because they're probably not going very high.
Yeah. And I think two things are worth mentioning is that, one theme and acronym that was made up over the last several years, most of this bull market really is TINA. There is no alternative. So you've
That's
been in
right.
this situation where you're not going to buy fixed income. It's trending down. It doesn't look good. So then, well, where do you put your money? You pile it into equities, get what return you can. But then what's really important is that if you're going to ride this wave higher and valuations are getting a little stretched, manage the risk. So I think that's always what's nice is when you have a planned exit. If it keeps going higher, great, you're on for the ride, but you don't want to just sit there and hold and just let the market kind of take you to the cleaners. You want to be in there managing that risk.
That's right. That's why we use the trailing stop losses. Okay, so I found one thing that I can just quickly, before it looks like we got a minute or two before we're going to wrap up, but I'm going to share my screen, I think, here real quick. If I can figure out how to do it and just kind of show the rate of change in inflation. So can you see my screen, Kyle?
Not yet.
Maybe you need to stop sharing yours.
All right, there we go.
There we go. So let's see if I just want to a little spotlight on it. Okay, so what I do is we get CPI prints every single month, but I try to smooth them out and do them for the full quarter. So in the quarter ending September 30th of 21, those 3 months, so what is that? July, August, and September of 21, average CPI was 5.4%. For the 3 months ending 12/31/21, CPI averaged 6.7%. We haven't gotten, and that's not true either. We haven't gotten there yet to 3/31 of 22. We'll get that information at the beginning of April, maybe April 12th, if I remember right. So I guess more towards the middle of April. But what I want to highlight is here in cell C3, right, where it says 24.2. So the rate of inflation increased from 5.4 to 6.7%. So it went up by 24.2%, right? And in order for it to basically maintain that same rate of growth, right, which would lead to an inflation up arrow on the macro chart we looked at, or at least sideways, right? Inflation needs to average 8.3% over the first quarter of 2022 in order to maintain that first derivative number at 24.2%. I guess it's at 24.5, but close enough, right? So if it did this, the second derivative would actually be positive by a small amount, right? Because it went from 24.2 to increasing by 24.5. And so that would be enough for an up arrow in that macro framework we were looking at. So we're doing not just the first derivative, but the percentage change in the first derivative is the second derivative of those numbers. And in January, CPI came in at 7%, and in February it came in at 7.5%. And so in order to get to 8.3%, I think we need to print a 9.5% CPI for March when it comes out in April. And I just don't see that happening, not even with oil going up as much as it has. I just don't see it going that high. And so, I think the rate of change in inflation is actually going to slow. And this is just a picture, so I can't change the numbers on the fly here. But if this comes in at, say, 7.5, then this number is going to come in at less than 24. And this number here is going to end up being negative or down. And that doesn't mean that inflation went down, right? So this number could come in, let's say it comes in at 8.0. Well, inflation is still higher than it was last quarter. and it's still high on an absolute basis. It's just not increasing at an accelerating rate, or maybe not even increasing at all. It's probably declining. And so I think we've already seen peak inflation for this cycle. And this is what I base that off of, is from looking at the quarterly numbers and sort of doing a little bit of homework, doing a little bit of math. And on the GDP front, you can see that GDP, and the reason I do this quarterly, by the way, is because we only get GDP quarterly. We don't get that every single month. And then it gets revised a whole bunch of times because they never get it right the first time. But, GDP grew by 2.3% at the end of third quarter last year. It grew by 7% at the end of the year. So for the fourth quarter of last year. And from 2.3% to 7% represents a 204% change, right? So it went from 2.3 to 7 is up by 204%. If we'll put it this way, if it went up by 204% again, that means GDP would be up year over year 21.3%. It's not. That's not going to happen. It's not going to happen. So GDP is also going to get a down arrow in our macro framework, right? And that's what leads you into what we call quad 4, where gold does really well, which it's doing, and stocks do pretty poorly on average. I mean, quad 4 is a career ender, for people who just buy high growth stocks, or for all these kids who, took their stimulus checks and bought GameStop and AMC. In quad 2, you can get away with that. When GDP is going up, when inflation's going up, everybody can be a stock picker. Everybody. It's really not that difficult, because pretty much everything goes up. That's why Cathie Wood and her ARK fund went to the moon, during quad 2. But the moment that the narrative changes and, those things totally flip around, well, it becomes a very difficult market to try and pick stocks. I mean, the best traders in the world are going to have a hard time picking stocks in quad 4, because every single breakout just gets sold. And then everything makes a lower high and then drops to a lower low. And until that cycle breaks, which is kind of what I was writing about in my last commentary, it's just not worth it to try and aggressively buy stocks, because you really don't need to pick the bottom to make a lot of money coming out of a correction or even a bear market. You just need to know when the trend has changed. And so that's why we're going to keep looking at this stuff. It might take a quarter or two before it resolves. But ultimately, I think the Fed is tightening monetary policy into a slowing economy. I think that creates a lot of macroeconomic risk. And I just don't see any reason to get aggressively long at this stage of the game. So, looking for opportunities everywhere we can. But I don't know. We're just not aggressively buying anything. I'm not buying anything aggressively in my personal accounts, using like half size that I would normally trade on trades. It's just not a good opportunity to be getting long the market.
Yeah, and you're right, Shane. I think this time it's just, it doesn't mean fully get out, but the most important thing here is knowing how to manage the risk, and, don't do we call it a round trip trade. So don't get in at 10, watch it go to 80 and come back to 10 and get out at 10. You want to manage that risk and kind of, you wrote it up. And now if that trend's breaking, you manage that and you get out of the way. But, we'll see what this see what this brings, but look forward to next week. We'll see what updates we have.
All right, everybody, take care. Don't forget to listen to the upcoming awesome disclosure statements.
Awesome. Thanks, Shane. Have a good one.
Bye.